Welcome again to Hidden Truths. And today we have Bob Barone, who is going to speak about the seeds of deflation soon by the Fed. Hi, Bob. How are you doing today?
Doing really well. Had a great vacation, so I'm all hyped up.
We're all re-energized, ready to go.
I went
Great.
to Italy, and it was really fun.
Yeah, I know. I'm sure everybody wants to hear. You just mentioned that you went to a wonderful cooking school next to Rome. Some of the best foods in the world, the Italian food, right?
Absolutely.
Great. So, Bob, you recently wrote a piece that was entitled The Seeds of Deflation Sown by the Fed. And in it, you discuss such things as the Fed's fixation on lagging indicators. And in addition, you have some data that shows that the labor market isn't as strong as the Fed believes. Can you elaborate on that, Bob?
Sure. We've seen a large number of layoffs announced by the corporate world in the past few months, but the unemployment rate hasn't seemed to respond to it. And in fact, in the last iteration in April, the unemployment rate fell to 3.4%. That's tied for the lowest level since 1953, so 70 years. And of course, the politicians are gleeful. They'll all take credit for it. But the fact is that the unemployment rate fell not because of jobs, but because people left the labor force. And really, that's not a very good sign for economic growth. The Fed is fixated on what I call lagging indicators. Meaning that changes in the indicators that they're looking at show up several months after the economy has shifted gears. Nevertheless, these lagging indicators are at the top of the Fed's lists. In the recent press conference that Chair Powell had after the Fed announced its 25 basis point rate hike, he said one reason that they raised the interest rates was that the labor market was really strong. So let's really look at that in detail. The payroll number that he was referring to was 253,000, and the markets had estimated 185,000, so that the 253 was a substantial beat to what the market thought. What wasn't mentioned anywhere in any of the media stuff that I saw was that February and March numbers were revised down by 146,000. That's very large. So on net, if you look at the growth from the March number that we originally had, it was only 104,000 after we subtract the revisions. And that's 81,000 lower than what the market forecast before the number came out. Mm-hmm. In past podcasts, I've also talked about something called the birth-death model. And this is a number that's simply added by the Bureau of Labor Statistics to the payroll number. It's not counted anywhere, it's just added. And it's added because BLS does not survey small businesses. And they have a time series trend that says over time, small business employment grows. I don't dispute that. I think that's correct. But what I do dispute is that it grows in a straight line, because it doesn't. It follows the business cycle just like the big companies do.
Right.
The birth-death number, that's the number that was added, was 176,000. So the actual counted number, if you say the 253 was counted, was only 77,000. That's the 253 minus the 176 that was simply added on. And if we adjust for the downward revisions in February and March, the 146,000 job revisions downward, the net number turns out to be minus 72,000. So after going through all the gyrations and really looking at what's happening, the employment number was not strong by any means.
Mhm.
So I have a chart that shows the rapidly shifting market expectations for the Fed funds rate. We see the fall in the expected rate in March, which is the orange bars, and then its rise in early May after the Fed meeting. Those are the gray bars. And then they've kept on rising. So last Friday's is the gold bars. And so we can see that they were initially high, then they fell because the Fed, because we're going to have a recession, and then they've risen again because the Fed seems to be just looking at these lagging indicators. So there are other besides what I just talked about, the payroll report. There's other indicators that the employment market is weak. The household survey, which is the sister survey to the payroll survey, shows that non-agricultural and salaried employment, that's most folks, that fell 96,000 in April. If we look at the work week, it shrank again in April. It shrank 0.3% and has been flat or down in 13 of the past 14 months. So the work week is down to 33.8 hours, and it was over 34 a year ago. So people, I mean, if you multiply those 0.2 hours by the 170 million people employed, you get a lot of hours that aren't being worked that were before. Here's a good one: temporary help agency. These are the agencies that you go to when you need help, the employment agencies. The employment in employment agencies fell 23,000 in April, and over the past 6 months, it's fallen 139,000. So scratch my head. The labor market can't be very strong when the headhunters are cutting their own heads. Now, that makes a lot of sense. Then there's this thing called JOLTS. That's Job Opening and Labor Turnover Survey, which is a monthly survey, and it's a favorite of Fed Chair Powell. And it showed that job openings contracted 384,000 in March and are down 3 months in a row. Hiring fell 1,000 in March, and on top of the 117,000 that it fell in February. People quitting, which is always a sign of how strong the labor market is, when a lot of people quit because they get a better job somewhere else. They were down 129,000 in the April JOLTS report, and they're down in 3 of the last 4 months. And then in that report, layoffs were up 248,000.
Mm-hmm.
So there's another chart that I have there that shows in the S&P 500 quarterly reports how many times job cuts and labor shortages are mentioned in those reports. And you can see from the chart that the yellow line is the labor shortages and the black line is the job cuts. And you can see in 2022 how short labor was, because shortages were really high and job cuts were really low. Now, if you look at the right-hand side, you can see that those lines have crossed, and job cuts are now higher than labor shortage mentions. So, conclusion is the so-called strength in the labor market is not very strong.
Yeah, it's a big reversal there. Yeah. So since mid-March, we lost 3 fairly large banks have failed, right? The Fed and the Treasury say that the banking system is healthy, and they say it's resilient, and that the crisis is behind us. What's your take on that?
Yeah, not. My view is that it's way too early to assess the damage from the chaos in the banking system. It's highly possible and maybe even probable that more banks are going to fail. In fact, today the markets were again attacking PacWest, one of the big regionals, which looks like it might be the next one to fail. And so if you actually look at the stock prices of the regional banks, and you can see it on the chart here, those stock prices have been falling March, but they've continued to fall in April and now here into the first half of May. In addition, with all this banking chaos and turmoil, credit conditions have massively tightened. Well, this means that it's harder for people to get loans, that interest rates are going up, that the banks are not making as many loans because they've tightened their credit standards. And all this is going to have an impact in the future because it means that economic growth can't grow. The economy can't grow because our economy is really dependent on credit. Whenever the Fed embarks upon a credit tightening cycle, especially one like we just seen, a really rapid one, the initial impact occurs in the financial sectors. That is, something breaks. We saw this in the 80s, Lincoln Savings and the savings and loan debacle. And then again in 2008, Lehman Brothers failed, and then 25 banks failed. In today's world, 3 banks that have failed so far had assets in the aggregate greater than those 25 bank failures 18 years ago. And you can see that from the chart. You can see the 3 banks and how many assets they had stacked up against Washington Mutual, which was a big bank failure, the biggest in history. And then the other 24, as you can see at the top of the chart. This particular Fed is obsessed with inflation and is only focused on the backward-looking year-over-year inflation rate. It says nothing about what the future looks like. The Fed made the same over-tightening mistake in 2008 and caused the Great Recession. Let's go back to 2008 and look at what the CPI was at a particular point in time, like we are today. The CPI inflation back then was 5.6% compared to today's 5%. So about the same. A year later, the CPI was minus 2%. So it's very possible that we can be seeing the same scenario play out here over the next 12 months. So if we think about it, interest rates themselves don't impact inflation. Inflation is impacted by supply and demand. In the current case, the original inflation was actually caused by the supply chain issues that we had in the pandemic. So a lack of supply that caused prices to rise, capped off by the federal government sending everybody free money, and then the Fed participating in that scheme by creating the money. That's what caused the current inflation. It was the free money and the Fed creating that money for the federal government to send out. Let's also remember that the Fed kept interest rates exceptionally low from the end of the Great Recession to last March, so 15 years. A simple view of the banking system is this. They take in deposits and they use those deposits to make investments, either in bonds or by making loans at a higher rate than what they pay on the deposits. That's how they make a profit. Over the period when the Fed kept interest rates ultra low, that's that 15 years, the banks had deposits, so they lent money out at a very low interest rate. It was higher than what they were paying on the deposits, which was essentially zero, but it wasn't nearly as high as the rates are today. So the rapid rise in interest rates that has been engineered by the Fed caused the market value of those loans and investments to just really plummet. So if a bank has to recognize the losses on those investments, which happens when they have a run on their deposits and they have to liquidate those investments to pay out the depositors, there is a strong chance that the capital on their books gets written down and is completely depleted. And that's what happened to Silicon Valley Bank, Signature Bank, and First Republic. And it still could happen to others, especially as the Fed continues to raise interest rates.
Makes sense, makes sense. Bob, the latest consumer price index came out for April, right? It was recent. It showed inflation that's still running about 5% from a year ago. You've said that you think that we're going to see deflation over the next year or two. Can you explain your reasoning?
Yes, as I said earlier, interest rates don't affect inflation. Demand and supply does. In the current case, by raising interest rates rapidly, the Fed causes significant strains in the financial system, and that in turn causes banks to stop lending. And the higher interest rates themselves cause consumers and businesses to slow their spending. So when the banks stop lending and consumers and business slow their spending, we get a recession. Lower demand in a competitive economy. Just think about that. How do we get lower prices? There's lower demand, and so if I'm not buying the candy bars that I used to buy, then the store that I'm buying them from lowers the price to try to get me to buy them again. And we're starting to see that kind of behavior. I have a long list of commodity prices that have all fallen double-digit levels from their cycle peaks. For example, oil. Its high price here in the last year or so was $122 a barrel, and it's down to about $71. Copper, the price of copper is off 20%. Steel is off 38%. Aluminum, 40%. Lumber, 78%. Eggs that everybody was complaining about, if you go to the store, you can buy them for almost just a little bit more than you did 2 years ago. They're down 82%. My list goes on and on. Despite what you hear on TV, it does appear that the recession has already begun. So my guess is that the National Bureau of Economic Research, this is the institution that officially sets the dates for the recession. When they get around to doing it, they're going to say that the recession either started in the first quarter or in the current quarter that we're in. Mm-hmm. So I have a whole bunch of indicators that are evidence that we already are in a recession. The first one is the Conference Board's leading economic indicators. They peaked in December of 2021, and they've been negative every month since. That's 15 months in a row. If you look at the chart, you can see the very close relationship between GDP and the leading economic indicators. The leading economic indicators are the blue line, and the GDP is the gray line. So if history has anything to say about this, we'll see negative GDP here in the next quarter or two. The leading economic indicators lead by 14 months on average. So if they peaked in December of 2021, that would make March or April the recession start date. In the first quarter, GDP was really quite weak, with most of the strength for the quarter occurring in January. And then we saw significant deterioration in the economic activity in February and March. So the handoff from quarter one to quarter two was quite weak, especially in consumer spending on durable goods and on cyclical services. We saw significant deterioration in the housing market, in construction, and in inventory investment. In fact, inventories are in the process of being liquidated. Just go to most stores and you'll see stuff on sale. Inventory liquidation is a big negative for the gross domestic product calculations. In March, retail sales fell 1%, and that was on top of a fall of 0.2% in February. Department store sales were off 2.5% in March, after being off 3.7% in February. Clothing was down 2% in February and March. Auto sales, negative 1.6% in March, minus 1.3% in February. Auto sales have been down in 4 of the last 5 months. Building materials were down 2.1%, and even groceries were down, not much, 0.1%, but they were still down, and groceries have actually been down in price in 3 of the last 4 months. So that's good news for the consumer, but bad news for the GDP. After being shut in during the pandemic, the U.S. consumer went on a massive service sector spending spree, especially in services like travel, airlines, hotels, restaurants. That's all now faded. March retail sales show that spending on services, those are the restaurants, the hotels, the airfares, the movies, the sports, entertainment, theme parks. In March, these are down 0.6% in real terms. That's after inflation, on top of February's negative 2.2%. And that kind of spending has fallen in 4 of the last 5 months, just another indication of a weakening economy. J.P. Hunt, which is a big transportation company, said in their quarterly report that the U.S. is in what he calls a freight recession. Freight, that's goods moving. Truck cargo volume is down 13% on a year-over-year basis. In April, railway car loadings were down 3.4%, and activity at the ports of Los Angeles and Long Beach are off over 25% year over year. In addition, shipping rates have fallen dramatically. There's an index called the Baltic Dry Index, which is a benchmark shipping index, and it shows that volumes in shipping are off 72% from their peaks. Another indication that the world's economy is slowing down. All the manufacturing surveys also show weaknesses. The Fed's regional banks all do surveys. So the Richmond Fed survey in April was minus 10. The Philadelphia Fed's latest was minus 23. There's a survey done monthly by the Institute for Supply Management. They have a manufacturing survey. It was at 47. 50, anything below 50 means contraction. So it was at 47. And it's now been under 50 for 6 months in a row. Chicago Fed has an index that's equivalent to the ISM manufacturing index, and it's contracted for 8 months in a row. Everybody knows that home prices are falling. The latest Case-Shiller index was up 0.4% on a year-over-year basis. Remember, it was up over 20% a year ago. And so for it to be only up 0.4 means that over the past year, we've seen prices of housing stabilize and start to fall.
Mm-hmm. You have characterized these Fed's actions as driving a car by looking through the rear mirror, the rear view mirror. They know where they've been, but they don't know where they are going, right? Can you explain what you mean by that?
Yes. The Fed is glued to the backward-looking year-over-year rate of inflation instead of concentrating on current and forward-looking data. On a year-over-year basis, CPI inflation peaked last June, that's June of 2022, at 9.1%. That's on a year-over-year basis. Last month, that same measure was 5%. but the monthly growth was just 0.4%. And if you look at the way that index is constructed, you'll find that rents and used car prices, which showed up as high in the April readings, but the method that the Bureau of Labor Statistics uses for these two, rents and used car prices, they use data that's 3 to 6 months old. So we know from current data, so we have the Manheim used car price index. We know that that's fell 3.1% in April. And we know that rents have been falling now for 4 or 5 months. So if you just take out those out of the index and substitute 0 for them in the index, when we know that that they were actually negative, the core CPI rate would have actually deflated by 0.1%. So let me emphasize that again. If you just get rid of the rents and the used car prices and set them at 0 in the index, when we know that they're actually falling, then if you just set them at 0, we would have actually seen deflation in the CPI in April. But the Fed doesn't look at this. The Fed is just looking at the backward number of 5% and is still worried. If we actually look at someone who takes the CPI and gets rid of those rents and makes them modern, makes them up to date, let me say it that way. If we look at Penn State's alternative measure, so they have an alternative measure to the CPI where they've substituted an up-to-date index for rents and an up-to-date index for used car prices. You can see from the chart, Penn State is the red line and the CPI is the blue line. Penn State is much more realistic than the CPI. And so you can see where inflation really is almost back to 0. Earlier I told you that commodity prices have been going down. Oil is the world's most important commodity. Its price is now hovering at $71 a barrel, down from 122 last June. And this is occurring in the face of the fact that OPEC is cutting production. That says a lot about demand.
It does, for sure. Yeah, great information there, Bob. Can you give us some final thoughts and sum all of this up for us?
Yes. So in the face of overwhelming evidence that the recession is here and evidence that inflation is actually rapidly falling, and in the face of a significant stress in the banking system and 3 failures of large banks, this Fed, what did they do? They chose to raise interest rates again early in May. This really looks like overkill to me. The icing on the deflation cake is the negative year-over-year growth in the money supply. This is the chart here is a chart of what is called M2. It's demand deposits, cash, and time deposits. For the first time in the history of this series, going back to the 1950s, the year-over-year growth rate in M2 is negative. I find it strange that this isn't being discussed in the media.
Yeah.
If you look, so this is called the quantity theory of money. It says that inflation is based upon how much money times its velocity is outstanding. And so when the Fed adds new money, we get inflation, especially when they add it rapidly. And you can see from this chart that they did add it rapidly in 2020 and 2021. And now look at the right-hand side of the chart, and you'll see that it's actually negative, again, for the first time in its history. So this shouldn't leave any doubt. So the big spike up in the money supply a couple years ago is really the source of the current inflation. Mm-hmm. And the recent negative in this series on the right-hand side all but guarantees that we're going to have a significant period of outright deflation over the next year or two.
Right. Well, the signs are here. You predicted this about a year ago already, right? You've been saying this for a long time now, and it looks like your predictions are happening.
Yes. Yeah, it's when you read the tea leaves like I do, sometimes you get ahead of yourself, and your predictions are right. It's just that sometimes it takes a while for it to work through the economy.
Yeah. Already great. Thank you so much, Bob. I really appreciate your insight. Very valuable information as always. Thank you very much.
Okay.
Everyone, thank you so much for watching. Remember to subscribe to the channel and share with your network. Thank you and see you next time.